So I hope you would have gone through from the first and introductory lecture regarding the financial management. So this is going to be the second one in which we are going to talk in detail about how to analyze your financial statement. So there are different ways, there are different techniques for that. I have already given you information that for the sake of understanding the financial management, you are always concerned about your financial planning. And when it's about financial planning, then you must know how to analyze your financial statements. If you are able to comprehend and analyze the financial statement uh, in a very great manner, so that you can easily take the next financial decisions. So there are so many techniques like a common statement, okay, then comparative statement, and after that there are trend analysis, then balance sheet analysis, then number of things are there. Okay, so we shall be talking about in detail marginal costing, then CVP, standard costing, whatever the different ways are there for analysis of your financial statement. So basically, if you ask me the question that why this lecture is necessary for you, and in this lecture you shall be getting the knowledge of how you can take the further decisions regarding your financial planning. So you can take your further decisions only if you can uh, basically and in a very detailed manner do the analysis of your past financial statement. So in this video lecture, I shall be teaching you in detail how you can do that. So I hope you would enjoy that. I'm now just going to share the screen. See that. All right, so we have already talked much about financial management, yet I have taught you an example on the basis of which we shall be covering everything relating to financial management. I have already taught you regarding the different structure and basis for the financial management. We have talked about the different chapters we have to study, and the most importantly, the second step or the second stage in the financial management, that was regarding sources of finance. Sources of finance uh, I have already taught you. So now in this video lecture, we are just going to cover how you can make the best and efficient analysis of your financial statements. How many different ways are there by going through which you can make the best kind of or the efficient assessment of your financial statements so that you can invest in. Regarding the financial statements, I have already taught you a lot of things. Okay, if you have a manufacturing concern, then trading account is the first financial statement. If you don't have the manufacturing concern, then obviously profit and loss account is going to be the most important one, and the balance sheet is always there. So these are the basic kind of financial statements which are to be analyzed first of all, so that you can make the further business investment. So for making the further investment, what you have to do, you have to analyze your financial statements, and there are different ways to analyze the financial statements which we have to cover in this video lecture, because these are important not only from our exam point of view but for your general understanding as well. Because if you are thinking of a new business idea or investment opportunity, then first of all, what you have to do, you have to analyze your present status, where you are standing right now. And for making analyze of that, if I talk about the analysis of your current or present situation, I generally mean to analyze your current financial statements. So if you have made the analysis of all these statements, then you can get the complete idea and picture into your mind, that where you have to invest and how you can invest, and where are the different systems, and where are the good and profitable opportunities which can provide you better and efficient returns in the coming future. So I hope you have got the idea regarding the financial statements. We shall be talking about basically profit and loss and balance sheet, and I shall tell you how you can make analysis of all that so that you can arrive at the best and efficient decision of how and where to invest further. So there are some ways, and I shall directly come to the point. Okay, I shall directly come to the ways. So from exam point of view, if I'm going to tell you, this is two individual technique or individual way you must be aware. Okay, they can ask you relating to trend analysis, they can ask you relating to common balance sheet, they can ask you comparative statement, they can ask you regarding CVP analysis, they can ask you regarding ratio or anything. Okay, so to individual way or individual technique you must be aware of, and you shall have the complete knowledge when you shall listen this video lecture very carefully. So just going to move further one by one, I shall be teaching you all the techniques. The first is a trend analysis. First of all, you have to see the trend of your business. Trend analysis. So a trend analysis is a method of analysis that allow trader to predict what will happen with a stock in a near future. If you have done the trend analysis like that, so that it can give you an idea of where you are going in the near future. So in trend analysis, the data is shown in different years as the trend. Okay. So trend analysis is based on historical data about stocks performance. So usually what we do, if we have to pick any stock for the further investment, what we do, we just make it a trend analysis, and it's big picture. You can see like this. Okay, so at the end of the different years, like for the year 2013, 14, 15, 16, 17, 18, so this is the complete trend. You can see that what was the real or potential income. This is just an hypothetical example of a picture image which we have taken from the Google simply. So this is just telling you trend of the real rental income. So just taking the look at that trend and just plotting it on a simple table in which the time shall be written in OX axis and the values shall be written on the OY axis. You can simply plot it, and when you will make the line plot of that, you will get the idea of where you can go in the near future. So this is the first way for making the analysis of your current situation. The second way is obviously of a common size analysis. So what's that? This is common size income statement and balance sheets and profit and loss account. Obviously, these are shown in analytical percentages. So by just looking at the picture, you'll get to know the idea of that. Okay, so this is a kind of a common size system. So what happens here, you can see that for different years, for year 2010 and 2011, the figures have been written for the balance sheet. Like this is cash, account receivable and inventory. Some values are written over here. Okay, and this is the regular format. And what happens, you just convert these figures into some percentage format. Now you can see that these same figures have been written here, cash, account receivable and inventory, but these have been written in percentage format. So in this way you can get the better idea of how much fixed assets are there or how much cash is there in relation to total assets of yours. So this is what the common size statement is, and this is just an example of a balance sheet. In the same way you can prepare the income statement and you can prepare the profit and loss as well. So the exam shall not ask you to prepare the common size statement, because this is obviously not the good idea. The question is not going to be this much longer, but they can tell you about, they can ask you about the real meaning of a common size statement. So common size statement is a statement in which the actual figures are shown along with the percentage format of that, so that you can get the clear picture of what an individual item stands at in a relation to the gross figure. So if we are reading this again, now you shall easily understand. If you have more than 1 year of financial data, you can compare income statements to see your financial progress. So this type of analysis will let you see how revenues and spending on different types of expenses changed from year to year. So in analytical percentages, you show all the things in the common size statement, and in this way you can make the analysis of how you shall go in the near future. The third one is the most important, and this is one of the thing which is about which number of time the question have been asked. Okay, so this is fund flow statement. So this is a statement similarly like balance sheet, but this is not exactly a balance sheet. Just take my words into your account, into your mind. Okay, so this is similarly to balance sheet, but not exactly a balance sheet. So what is this? This is a statement here, on this side, on the debit side. I'm just plotting it somewhat bigger so that you can get idea. So here on this side, debit side, sources are written, and on the credit side, applications are written. Applications. So in this side, in sources side, you get the name of all the sources from which you have got the funds in the previous year, which have directly or indirectly affected your working capital. Okay, and in the liability side, you just write the name of all those elements in which your fund was applied, or your funds or finances were paid off, which directly or indirectly affects your working capital, obviously. So fund flow analysis is the analysis of a flow of funds from current asset to fixed asset, or current assets to long-term liability, or vice versa. So at this, in a transaction, obviously you are a students of management or commerce, then you would have got the idea that each and every transaction has at least have, obviously, exactly, it's two sides or two effects. The one effect is a debit and the second effect is credit. Okay, so in any of the transaction where one side is of current current nature, current account nature. Okay, current account nature, I mean to say current asset or current liability, and the other is of non current nature. So if in any transaction, if in any transaction which has two parts, one of a part relates to the current, one of the part is affecting the current asset or current liability, and the other part is affecting the non-current asset or non-current liability, then that transaction ultimately leads to the flow of funds, and that flow of funds is divided into two parts. The first is sources and second application. So first of all, we make fund flow statement and then study its cause and effect deeply. You will get to know its more idea only if you see the picture. So this is all about that. This is just in vertical format. Okay, so these are sources, these are applications. So from issue of shares you can get money, issue of debenture you can get money, from borrowings you can get money, sale of investment you can get money. From all these sources you can get money. So you can get to know that by issuing all these, you are getting the money. So in the debit side you are affecting a current asset, and on the credit side you are affecting a non-current asset or liability. In the same way, in case of applications, you have to pay funds. Okay, for redemption of share, redemption of debenture, repayment of loan, purchase of investment, purchase of fixed asset, you have to pay the money. So in the one side of the transaction you have current, non-current asset or liability, and in the other side you are paying the money, that is current asset. So this is all about that. So after making the preparation of this statement, you get to know the idea of where your funds have been applied and where you have got the funds from. So the sources you can rethink, and the applications you can rethink. So this is also one of the way how the financial statements are analyzed, because when you have got the idea about all the elements or all the areas in which your funds have applied, then you can rethink about all these applications, so that if one or two could be withdrawn, then you can take the efficient decision on that basis. So in this way we can say that the fund flow statement is the statement which makes you uh, uh, aware, or which makes you intelligent enough to take the further decisions regarding sources and application of funds. The next source is obviously cash flow analysis. Okay, so that deals again with a financial statements which is prepared for understanding or analyzing the flow of your cash on the basis of different activities performed in the business. So the purpose of cash flow statement is to show where an entity's cash is being generated and where it is being spent. So cash inflow and cash outflow study over a specific period of time. So okay, so it is important for analyzing the liquidity. So just for the sake of analyzing the liquidity of the concern, immediate liquidity, you prepare the cash flow statement or analysis. So it has three sides or three types. Okay, so first of all, I'm just going to show you this screen. So cash can be received from or paid to three different activities. The first can be operational activities, the second can be investing activities, the last can be financing activities. So in all these activities you can get the money, you have to pay the money. So in all these activities the cash is involved. So one by one we shall be talking about all these, although this subject has to be studied, or this particular topic has to be studied in detail when we shall be talking accounting. Okay, accounting subject we have to talk about. So what are operating activities? The net amount of cash coming in or leaving from day to day business operation is called cash flow from operations. Okay, so here non-cash items are not added. Okay, so like depreciation, amortization, so these kind of things are just non-cash items. So cash flow from operating activities is the cash which is received from or paid to all the entities which affect the business operations on daily basis. Okay, like these can be some immediate payment, some bank payment, some interest reception, or these kind of things. Then the cash flow from investing activities, wherever the cash is going to for making the investment, further investment, like purchasing of assets. These can be land, building, equipment, machinery, or it can cash can be received by selling the assets, businesses, securities, or anything. So from the investing activities, the cash you are receiving or the cash you are paying, that falls under a specific category of cash flow from investing activities. So I have taught you regarding operating, I have taught you regarding investing, and the final or the last one is the cash flow from financing activities. So what is this? This is the cash flow from finance activity. This is the cash out to flow the entity's investor and shareholders, and inflow from sale of bonds or issuance of stock. When you are dealing with the shareholders or the owner of the company, so you can receive cash from them when you issue them share, and you have to pay them cash when you redeem their shares. So the activities involved in that, received or pay the cash, so these kind of activities are covered under cash flow from financing activities. So this is all about that. So what I have taught you right now, this is that the cash flow statement is also the statement by which you can make the analysis of the present level of the liquidity in your business. And when you get to know the information regarding that, you can easily take the further decisions regarding which are the areas which can be abandoned in the next year, and which are the more areas in which you can, from which you can easily receive the money. So this is cash flow statement. And the next one is a ratio analysis. About this we have to study in detail. Again, I'm talking to you, if when we shall start the accounting subject, then we shall talk about ratio analysis. So in that, what you do, you just find so many ratios in the company, of the company's financial statements, and you just categorized these ratios into different elements. Like you calculate the liquidity ratios, you calculate the efficiency ratios, you calculate the profitability ratios, you calculate solvency ratios, and on basis of these ratios further managerial decisions can be taken. So this is also one of the most important way of making the financial statement analysis, so that the further and future decisions can be taken easily. So this is also the way. The next is a CVP analysis. The CVP analysis is simply the another name of marginal costing. You study that, you make the analysis of CVP. Okay, so on the basis of cost volume profit analysis, this is the best and the contemporary approach for taking the managerial decision, because it allows you to reduction in your cost. Because this is very obvious, I'm going to give you a very beautiful example of that. What is this? uh, your ultimate aim to is to earn the profit. Okay, your ultimate aim is to earn the profit. How profit can be increased? Increment in the profit can be done in two ways. Okay, suppose your product is, you had to spend rupee 100 for making a product. This is your cost price. Okay, cost price. You can offer this in the market for 120 rupee. This is your sale price. Okay, so 20 rupees your profit. So there are two ways to increase your profit. So the first way is you can increase your sale price. So if you increase your sale price to 130 rupee, then you get the profit of 30 rupee. But this is not always the case. Why? Because if you are increasing the price of your product, then the demand shall be lowered in the market and people shall switch over to some other products. And the second efficient and best way to increase your profit is just keep your sale price at 120 only, but try to find some ways so that your cost can be reduced further. Suppose if you have found the way, and way in the sense that your cost has become 90 rupee. So when you deduct 90 from 120 rupee, you are left with a 30 rupee, and this is again a very good return, which is the same profit as this is. Okay, so in this, so this is the higher profit actually. If you mathematically we can prove that. So this is the way. So we can make the conclusion by this example that gaining much of the profit, or making possible to earn more profit, can be done in two ways. First, you can increase your sale price, which is not always the case. Or second way is you can reduce your cost price, and this is the very efficient way. And CVP is concerned with the reduction of cost price. So marginal costing or cost volume profit analysis make the analysis of all the costs occurred, all costs occur. And once you get the complete idea of all the costs in your organization, you can efficiently make the decisions of how the costs can be cut out further. So this is known as a CVP analysis, in which all the individual variable costs are studied and the decisions are taken which costs can be cut down, and which costs are very irrelevant and are not producing or are not generating maximum returns. So this is also one of the way to analyze your costs, so that the further decisions regarding these can be taken. So I think it's all about that. Okay, oh, one is left. This is comparative statement. I have already taught you common size statement. In case of a comparative statement, this has only one difference from the common size statement. Okay, so again, here the statements are shown in comparative statement. I think you shall get the idea from this statement. Okay, so I have added a simple income statement, and that has been hypothetical taken by downloading from Google, obviously. Then you get some figures for 2016, for 2017 as well. In common in income statement, in common statement, what you used to do, you just wrote the raw figures or the actual figures, and you wrote the percentage of that. But what happens in comparative statement, in that you make the actual comparison on year basis. Like in, these are the figures of 2016, these are the figures of 2017. You just make the analysis of a change in these. Like the net sales have grown for 50,000. Cost of goods sold has grown for 30,000. Gross profit has grown for 20,000. So in this way, you just analyze the absolute change and you just find the actual percentage change as well. So this is how the comparative income statement can be changed. And if we are making the characteristics and the features of that, what are these? In the comparative statement, actual figure or absolute figures are shown like these. Like these are the actual or absolute figures. Second, changes in absolute figure is also given. So change is also given. This is in absolute figures. Then absolute data in terms of a percentage is also given. Okay, so absolute data. So their individual percentage can also be given, which has not been shown in this specific picture, but that can be given. Then increase or a decrease in term of a percentage. So increase or a decrease in term of percentage is shown. After that, a comparison can also be expressed in ratios like 2:1, 3:1. In a ratio, it can be shown. So I think that is all about a comparative statement. So if we are making the differentiation between common size and a comparative statement, in common size statement, only the absolute figure and the absolute percentage is given, and none kind of a change is considered for study. But in comparative statement, the absolute change is also studied along with the absolute change percentage. So I think I have taught you enough regarding the analysis of your financial statement. So this is one of the major thing which each and every financial analyst has to do so that they can make the further business investment decisions. So in this video lecture, we have talked about the different techniques used for analysis of financial statement. First, I taught you regarding trend analysis, then common size analysis, then funds flow analysis, cash flow analysis. Then I taught you regarding a ratio analysis, then cost volume profit analysis or marginal costing, and finally the comparative statement. The next lecture is obviously if you know the complete structure of what I have taught you regarding opening a business on the from the point of view of entrepreneur. So if you still have in your mind, then you can easily get the name of the next chapter. First of all, I taught you regarding you have to generate the ideas. After that, you have to find the sources of finance. Then you have made the analysis that I have already taught you, and the next is going to be how you are going to get money, how you are going to get the money, and what is the percentage you are going to offer to different entities. So that's why we have to study the two beautiful and very very important concepts. This is going to be regarding the study of a capital structure and cost of a capital. Thank you so much for listening me. This is Gurpal Singh from Gurser Education.